Hi there, my name is Brian Koegle and I'm the president of Koegle Law Group. And today I'm here to talk to you about the importance of making sure that your business is keeping track of tips under the new One Big Beautiful Bill Act that was passed by our legislature back in July of 2025. The reason this is so important for so many California businesses, especially restaurants and those of you in the service industry, is because the rules are very complex. And as we look at the differences between the federal law, the One Big Beautiful Bill Act, and what's required in California, you can find yourself in conflict very quickly. The importance of being able to make sure you have good documentation, tracking the amount of tips that your service employees are receiving on a day-to-day basis is going to become essential as you move forward, especially for tax year 2026. It's incumbent upon employers to make sure that they're properly tracking the system. Most importantly, there's a misnomer out there that just because there is this new federal bill that says there's no tax on tips, it doesn't change your obligations as an employer. You are still required to make sure you're making all lawful federal and state deductions from tips that are received by your employees. The employee then is able to file in their tax return at the following tax year for a refund of those taxes that were paid in the year prior. They'll still be subject to FICA. They'll still be subject to Social Security and Medicare taxes. And most certainly, they will still be subject to California state taxes on all of that revenue. So it's imperative for businesses to ensure that they're getting all of those taxes held back and paid to the appropriate taxing agencies on a regular basis. Additionally, one of the other misnomers here is no tax on tips is not an infinite number. In fact, the cap on non-taxable tips is $25,000 per calendar year. And then finally, there's also a phase out of this provision that provides that if you have a very high income earner, someone who's earning more than $150,000 individually, they will no longer be eligible for the no tax on tips deduction at the end of the year. And here's where things get really interesting. There are many times where an employee is earning very high tips during their work week, where so much so that it may exceed what they're making on their minimum wage that they get paid from the company, which is an absolute certainty and necessity under California law. You cannot compensate any less than the minimum wage and offset that by tips. So what happens in the circumstance where the person's tips were so far exceeding what they were paid in minimum wage that the taxes that are charged on those tips, especially for cash tip businesses, exceed the income of the employee? Well, in those circumstances, many employers will have to claw back additional monies from the employee in order to make sure that they're covering the appropriate tax sums that are due to the taxing agencies. That may mean that the employee has to give you cash. It may mean that they have to sign a written agreement that they're going to have this deducted from future payroll systems. There are lots of different ways to handle this. However, I will tell you many of the employers that we work with where cash tips are very prevalent and it's really the majority of the income for the employee are very often having to go and collect money from their employees to ensure that there's enough money in the till to pay out those tax on tips. Our biggest concern from a compliance standpoint lies in the heart of California Labor Code Section 351. In that section, the law specifically states that tips belong to the employees. It is their property, not the employers, not the companies in any way. Rather, it's their obligation to make sure that all of those tips are properly reported, that taxes are paid, and that at the end of the day, that they are claiming that income as part of their annual wages paid. And the problems that we're running into more often than not is this. Employers simply are not getting it right when they report on the payroll stubs of their employees how those wages were earned. Many restaurants still classify tips as wages on their pay stubs. That is not accurate. It needs to be a separate line item that is separately tracked, that shows the taxes, withholdings, and deductions from each individual source of revenue. This is specifically laid out in California Labor Code Section 226A that requires every employer to provide accurate pay stubs to every employee every single pay period. And if you make a mistake and you improperly report those tips, that's where penalties come into play. And penalties are expensive and they cap on top of each other. Penalties start at $50 per pay period per employee, and they go up to $100 per pay period per employee with a maximum penalty of $4,000. Not to mention the attorney's fees that get tacked on top of that. If an employee recovers even $1 in penalties, they are entitled to all of their attorney's fees to be recovered as part of that award. So when you think about how many employees you have, $4,000 times the number of employees can be a huge, hefty penalty if you aren't getting this correct. One of the most specific laws that we see in the California Labor Code comes in Section 351 that specifically delineates how tips and service charges are to be handled for employees. Tips are the exclusive property of the employee, him or herself. An employer cannot require an employee to share tips, to pool tips, or to require them to participate in a management sharing program for those monies that are received. A service charge is typically what we see when a restaurant instills a charge on the final bill, usually for parties of 6 or more or something along those lines. In those circumstances, the law views the service charge as the property of the employer, part of the employee's wages. That is not a traditional tip, and it is not treated the same way as tips when it comes to the California Labor Code. However, under the Internal Revenue Code, it's very important for employers to remember that those sums that are collected must be indicated as part of your gross revenue. You must list what those service charges are. If you're sharing a portion of that service charge with the wait staff, with the maitre d', with the back office, that also needs to be tracked down to the penny as to how you're splitting those charges. Where this comes into play most often is where the sum being paid to the employee is shown on the wage statements. Service charges would be part of the wage that is paid to the employee. Sums that are paid as wages are subject to regular taxation, including FICA and FUTA, Social Security, Medicare, and state income taxes. On the other hand, tips are handled slightly differently, subject to different FICA retention and deduction requirements. They are still subject to Medicare, Social Security, FUTA taxes, and state taxes, but the FICA gets calculated differently. So it's important to make sure that you're making those distinctions. Also remember, a key distinction between service charges and tips is that a tip is a voluntary payment by the consumer to the service staff. Under that threshold, that is the only thing that is considered a qualified tip for purposes of that $25,000 maximum deduction that your employees may receive. Service charge payments that are paid through wages do not count towards the $25,000 of non-taxable income for your employees. Obviously, this is going to potentially put businesses at odds with their employees because they want to maximize their non-taxable or deductible wages so that they receive more money back at the end of each tax year on their tax return. So be very careful to make sure that you're explaining and setting forth expectations for your employees early on in writing, laying out the differences between service charges and tips so that they understand what will and will not be a qualifying tip for purposes of their tax deductions. The W-2 form for 2026 has been updated, and it is imperative for you as the employer to begin tracking under a different code both qualified and non-qualified tips if both apply to your businesses. That means that in addition to their regular wages listed on their wage statement, you should have one line item for qualified tips and one item for non-qualified tips. This would include other compensation that comes to the employee throughout the calendar year. This is going to be important because if we mess this up, The employee will receive a W-2 at the end of the year that has inaccurate tax information, and they may not be able to take full advantage of the $25,000 tax deduction on their personal income taxes the following year. So please sit down with your payroll company to ensure that you have these numbers properly delineated and that you have separate line items on every pay stub to ensure that you're tracking those qualified tips on an annual basis. One more very important distinction between service charges and tips is the importance of making sure that you're disclosing any sort of service charges to your customers or consumers in advance of them making a purchase. This can be a declaration or statement that is included on a menu, such as an 18% service charge will be added to parties of 6 or more. It can also be disclosed somewhere prominent within the restaurant that employees and guests can see that a service charge is being charged by the restaurant in advance. If the first time that your customers think that there is a service charge added to their bill is when they receive the bill at the end of their meal, you are not in compliance with California law. Additionally, as part of that disclosure, if your restaurant is charging a service charge, you must also disclose to your customers that the service charge is the restaurant's charge and is not shared with your front of house or back of house staff. Regardless of how often you pay your employees, you are required to provide legally compliant wage statements at the end of every pay period, along with their paycheck or direct deposit stub. As part of that, California Labor Code Section 226 has 10 areas of information that must be on every pay stub. Among the biggest areas that we see a problem with, typically employers are putting the gross amount of the check, the net amount of the check, the deductions and the withholdings of the check, the employee's name and an identifying number or something that allows them to be identified within your system. But where we see the most problems, the legal name of the business must be on every single pay stub. The information of each individual category of income must be listed out. That means for restaurants and service-based industries specifically, you must split out and have a separate line item tracked to show how much money is received by your employees in tips per pay period. So if you pay weekly, you have to have an accurate accounting of how many tips were received and distributed to the employee during the week. If you're semi-monthly, you have to do that twice per month. If you're bi-weekly, you're doing it 26 times per year, every other week. But in every single one of those scenarios, an employer has to remember that on the tips, we are listing out specifically not just the credit card tips that are received by the employee, but the cash tips as reported by the employee, him or herself. Those both need to be included on the pay stub. And here's a tip. For those of you who are relying on your payroll companies to give you this advice, to tell you where you should be deducting, where you shouldn't be deducting, that is not a good policy. Most payroll companies will not provide you with legal advice, nor will they tell you how to comply with the regulatory statutes that are now being brought into play here. It's important for you to make sure that you have competent legal counsel who understands the ins and outs of this new law in order to make sure that each and every one of your wage statements is correct before you give it out to an employee. First, it's essential for every business to have a policy that requires its employees to report when they receive tips of $20 or more in any given month. So if you have an employee who infrequently receives tips but does receive $20 or more in a given month, they are required by law to report that sum to you so that it can be listed on their pay stub. It can be subject to withholdings and deductions. If you do not collect that data from employees already, it is essential that you begin doing that in 2026. Second, employers get this wrong so frequently. You are not permitted to pass along credit card processing fees on tips to the employees. In other words, if a customer or consumer tips $20, but the credit card company charges you a 3% surcharge because of the fact that they are processing your credit card payments. You cannot deduct that 3% from the employee. They must be compensated for the full $20 tip that was provided by the consumer on the bill. You do not have that flexibility to deduct credit card authorization or processing charges. That is deemed to be a cost of doing business that the company or the restaurant must take on themselves. And then the third point that many employers are messing up is if an employee receives a $20 tip, but they're required to share that with bartenders, barbacks, back office staff, or front office staff, you do not get to charge the employee for the full $20 tip that he or she received. Rather, you need to keep very specific and meticulous records as to how those sums were divided among all staff members. At the end of each payroll period, each staff member should have an accurate depiction of the actual cash that they received during the course of the work week or pay period. Additionally, just as one last reminder, you cannot have an employee forced to commingle their tips with any supervisory or management level employees or anyone at the executive level of the restaurant. This can be service staff only that is sharing in tips. And it's essential to make sure that when we're commingling or sharing tip amounts, that we have a specific ledger and we keep track of who is receiving what from the entire tip pool throughout the evening, if that is the process that your firm uses. And remember, it is absolutely essential that we are communicating expectations to our employees. That means you should have a written policy of how tips are handled, how they are divided, and then how they are reported to the employee each pay period. All right, so now you may be asking, why am I running a business in California? Well, the good news is we're here to help at Koegle Law Group. And our goal is to make sure that we are keeping your restaurant on the right side of the law so that you understand the importance of what these rules and regulations really mean for your business and for your employees. So what can you do to make sure that you're compliant? First of all, if you haven't reviewed your employee handbook in several years, this is the year to do it. You need to ensure that you have clear, concise policies in place that let your employees know what your expectations are and how you are handling tips and overtime requirements. Second, conducting an analysis, a review of all of your employees' pay stubs. Take a look at the requirements of Labor Code Section 226. Make sure that each and every one of your pay stubs has all of the 10 necessary pieces of information on that pay stub. For your service-based employees who receive tips, make sure that you have separate line items now for both qualified tips and non-qualified tips. Make sure that there is clarification in those pay stubs as to where the service charges are being paid, including if you're just putting it in the lump sum under their wages. Making sure that you have compliant wage statements will be an essential part of how you will avoid litigation in the future. Third, you do need to make sure that you have written notification to your consumers if your restaurant has service charges that are imposed, whether it's for large parties, whether it's for holiday service, whether it's outside of your normal business hours, or whether it's a big private party that you have in a private room. If a service charge is being charged, you must make sure that it is open and notorious to the consumer before they receive their bill. Additionally, you need to ensure that you're properly tracking service charges on the back end of the house to ensure that it is being tracked not as a tip, but as a service charge, and that you are making sure that you're properly reporting that to all of the taxing agencies. And then if that service charge does get distributed to your employees as part of their wages, it needs to be reported as such as part of their regular pay stubs. If you make those first three changes, you're well on your way to compliance with both federal and California law under these new regulations. So if you own a restaurant in California and you don't already have legal counsel, please call Koegle Law Group at 661-362-0813 or visit us at koeglelaw.com.